Hello everybody, this is Professor Choi again. There's some things happening in the market that require me to come up with this video so we can explain it a little bit to anybody who's following me. Now, this video will probably work for, whenever the next time happens. This is definitely not the first time that somebody has been hit with a big margin call. Now, what exactly is a margin call? So, usually when you're investing, you have two places where you can grab money. One money will be your own money. So you get your own money, you bring them into the account, and then you invest with that money. Another way is to basically borrow money from your broker dealer or whoever basically is allowing you to trade. Or to borrow money from other people, basically borrowed money, okay, and then bring it into the fund and use it, okay? Now, a margin call is basically when that person lending you money says that you have to give them some cash on that account because they have noticed that basically your account is going too bad in the wrong direction. And that's usually the reason why people will get hit with a margin call. The most common type of example is, let's say you are short a particular stock. And by the way, I have another video explaining what a short sale is. So when you are short a particular stock, if the stock is going up instead of down, down is when you make money on a short. If the stock is going up, then what would happen is you would normally get hit with a margin call after that has gone up too much, because usually when you're short, if the price goes up, you could have unlimited losses since there is no maximum price for a stock. So you may get hit with a margin call. So again, a margin call is basically when a lender on margin calls that borrower and asks for more cash in their account. And again, the way it would normally happen is, imagine that you invested this much money, but some of that money is basically borrowed money from somebody. Well, if your fund is moving too much in the negative direction, in the wrong direction, then what would happen is you would get a margin call from that borrower and say, hey, I need you to put some more cash on this account. Alright? And that's what a margin call is. Now, who can get hit with a margin call? Basically, any borrower can get hit with a margin call. It could be an individual, it could be a broker, it could be a hedge fund, it could be a regular fund, it could be a major individual who's investing. It could be a broker dealer that has their own margin account with somebody else. Alright? So basically, it's a call between the lender and the borrower, and the lender is requesting more cash in the account to secure that account. Alright, now what is the fallout from a margin call? Well, there are multiples. The individual or fund who got called is going to have to raise cash. Now, one way to raise cash, of course, is to call somebody else and say, hey, I need some money. So they could borrow money from somebody. The problem is that once you get a call, other people know that you're getting a margin call. And then what normally happens is those other people will margin call you as well right after. So this is not going to be a time for you to be able to borrow. And that's why a lot of people in the market basically say that the best time to raise cash is whenever people are willing to give it to you. Because usually when you need it, everybody walks away. Alright? So in any case, borrowing money from another company may not be an option. The next option, therefore, is for you to start selling some positions or put cash out of your own pocket. Now, selling positions is probably going to start happening. And this is why you start seeing the news and the fallout and who's next, etc., etc. Of course, when this company, whoever is holding all this stock that's going in the wrong direction, starts selling those positions, then it's going to make that stock change direction, especially if their position is very large. So this is going to cause those stocks or bonds that are engaged in this transaction to sell off or increase in value. It depends on what side of the trade you're on. In other words, if you're short or if you're long on some of these positions. But the point is, the larger the position you have in the market, then the more of a fallout will be on that particular stock or on that particular trade that's happening. There will also be a domino effect follow after that, of course, because those stocks will then move in a big direction. Now again, let me try to visualize what basically this is for you again. So imagine that this is all the money, all the capital that you have in your particular fund. All right, let's call it $1 million. And then a piece of that capital that you have is actually borrowed. So you brought it up from, let's call it Bank A. All right, and you have this stuff invested. Now, imagine that Bank A is looking at some of your positions. In other words, they're looking at the stock or the bonds that you're holding, or whatever asset you're holding on your fund here, and then they see that they're moving in the wrong direction. In other words, your position is too highly leveraged at this point. Then what would happen is Bank A will issue that margin call. And as they issue that margin call, what they're gonna say is, hey, this much money you have borrowed from me, I need more cash on this account, otherwise I'm gonna call the money back. You're gonna owe me that money right away. As a consequence of that, then they're gonna have to start, again, either borrowing from another bank, or they're gonna have to basically liquidate some of these positions. So they're gonna have to start selling some of the positions that they have in order to be able to raise cash to put it on their account. If this is a big enough fund, and that's why this matters. If it's an individual like you and me, we get a margin call for $1,000, then whatever, right? Or you get a margin call for $10,000, that's no big deal. But if it's a fund, and this fund has millions or billions of dollars, and they get hit with a margin call, then what's going to happen is they're going to have to sell off a lot of their largest positions. And that's when it becomes a problem. So it becomes a problem not only for the bank that is issuing the call, because they may not get paid back their whole money, it becomes a problem for the fund, of course, and it becomes a problem for anybody holding any of the assets that the fund has. And a lot of these funds are not very transparent. In other words, you and I don't know what they're holding at any point in time. So this could be any stock that is going to get hit in any direction, or any bond. All right, so the big domino effect is that if the fund is large enough, the lender that executes the margin call may lose money. And the reason they may lose money is because they may bankrupt the fund, or the fund simply defaults on the loan and they don't have enough money to send it to you. The fund assets are going to be selling off, and as they sell off, they bring down the value of those same assets. So in other words, you thought you had $1 million portfolio right up until the point where you start selling all that stuff in the open market and the price drops like a rocket. Okay? Now this can cause other funds to fail as well, or if there are other banks that also have borrowed accounts with you, they're going to start issuing margin calls again on your account, and then now that goes bad. Those banks may also be involved, and the loans may have to be cut as well. The stocks and bonds and assets involved may drop in value very quickly. Now usually this doesn't go any farther. In other words, most of the time that this has happened, it creates a sort of small ripple, usually either in the bond or the stock market, and then that's it. Nothing else major happens, things go back to normal, because most of the time when this happens, it's not a huge player. The huge player is the one making the call. And sure, their accounts may go down a bit, but usually they're not lending only to one person. Okay, now that one person may be huge, but usually it's not just to one person. All right, so in any case, by the way, if you're still here after the explanation, there's a really cool movie called Margin Call. So yeah, there's a movie called Margin Call that actually explains how this happens, and then the sort of domino effect that happens right after that. It's more of a drama, but it's really cool for those of us who are learning about the stock market. So anyway, thank you very much for tuning to Professor Choi today, and remember to like and subscribe if you like my videos. Have a good one.